Good morning and welcome to the Antipodes Global Investment Company's full year results shareholder conference. I would like to introduce Jacob Mitchell and CIO and Andrew Finlay, Managing Director. Thank you. Please go ahead, Jacob and Andrew.
Welcome shareholders to this call for the Antipodes Global Investment Company. We'll be addressing some slides or talking to some slides today. If you don't have them in front of you, you can access them on the ASX announcement for our call this morning, or see our website antipodespartners.com/ATL, or you may have received an email from the team here with the presentation attached if you're registered for the call. Right, straight into it. This is Andrew Finlay speaking. I'll just talk some highlights for the company results for year 2019, and then pass over to Jacob to talk through the portfolio in a bit more detail. First up, over the financial year 19, the company delivered a net profit after tax of 7.7 million. As per our results, this was a strong recovery after the first half of the year, in which the company made a loss on the back of difficult markets in late 2018. The underlying company performance, or NTA, if you like, driven by the portfolio, rose 2.7% over the course of the year. That lagged the benchmark of 11.3, primarily because of our conservative net exposure in a strongly rising market and our value style. As you know, the company's investment strategy is long-short, and there's plenty of protection built into our strategy. We do, from time to time, give up some of the upside in lieu of providing more protection in down markets. The board has announced the final dividend of 2.5 cents a share, which together with the interim dividend of 2 cents a share equates to a full year dividend of 4.5 cents. The dividend will be franked to 50%, and that equates to a 4.8% yield as at the date of the dividend announcement. I should also point out that when we compare to FY18, in FY18, shareholders may remember we made a final dividend payment of 5 cents per share. That did cover the full period since inception of the company, so over 20 months, which is equivalent to 3% annualised. So in a sense, the full year dividend this year of 4.5% is a 50% increase on the full year dividend of FY18. APL, like many global equity LICs, have been trading at a discount in recent months, and the board of the company is very focused on addressing this. And we've announced a number of initiatives in recent times, including an on-market share buyback of up to 10% of the shares on issue. We commenced in early August, and we're very focused on that. Excuse me. In addition, the manager and staff of the manager, so Antipodes Partners, the manager, and staff and executives of the manager have been buying shares in the company, and in aggregate, those share purchases now equate to over 6.5 million shares, which makes us a top 10 shareholder in the company. And then finally, I'll just note that together with our colleagues at Pinnacle, we've really been ramping up our shareholder communications more generally, conducting more webinars, calls, investor relations activity, really to get the word of the company out much more broadly. If I refer to slide 3 in your presentation, it's the waterfall slide just showing the movement in the NTA over the course of the year. I'll just highlight 2 points here. Firstly, the NTA move in aggregate across the year, most impacted by the dividends paid of 7 cents in total, and then the options dilution, 7.5 cents, and the options expiry we've been through a number of times before, expired in October 18. There will be no further impact of options dilution for the company going forward. On to slide 4, a summary of the company performance. to 30 June and also since inception. So whilst delivering strong absolute returns, the company's portfolio has lagged the benchmark, and Jacob will talk a bit more about performance in a moment. And finally, to the dividend timetable, dividend ex-date 6th of September and payment date of 14th of October. We want to leave sufficient time for questions, so what I'll do now is hand over to Jacob to talk about the portfolio. There is a slide in your pack, slide 5, just reiterating a few key points about Antipodes Partners, the manager, but in the interest of time, we'll jump straight to Jacob and a discussion about portfolio performance on slide 6.
Thanks, Andrew, and welcome everyone, shareholders. When we look at the performance, yes, in the last year, in the year-to-date period, it's been, as Andrew mentioned, tough. There's been headwinds for a more value-focused approach. However, we've also had, some single stock names that have not contributed in the way that we expected them to, and we've grouped them together there, Chinese internet gas producers. I'll quickly cover off on those. In the internet space, Baidu, which is the Google of China, and should have been quite, a resilient sort of business, given how search is, such a strong network effect style business, has proven anything but. And two primary reasons for that: Tencent and Alibaba have increasingly kept internet users inside their ecosystems with this sort of revolution in mini apps. So instead of accessing the internet via the search engine, via Baidu's search engine, increasingly people are using these mini apps to organize their lives, which is good for Alibaba and Tencent, not so good for Baidu. Secondly, there has been the emergence of ByteDance, which is, I think, the world's most valuable unicorn. So it hasn't yet listed, but it owns the business TikTok, which those of you who maybe have younger members of the family may have had exposure to. But it's quite a big business. It's become short videos, and interacting with short video format has taken about 20% of user time in the Chinese internet. So it's, and that brings a lot more advertising inventory to the marketplace. So there has been deflation in ad rates, internet ad rates. We haven't seen that in other parts of the world. So and it's, I think, just a reflection of the fact that the internet is maturing probably more rapidly in China versus the West in an advertising sense, because there wasn't a strong, let's call it, traditional, conventional advertising market in China prior to the internet. And we've also probably just reached the limit of how much time we can spend on the internet. So increasingly, it's a negative sum game, in the market's becoming more competitive now. Whilst we recognise these trends, we anchored too much to valuation. We kept sort of saying, oh, this is a cheap stock, and the changes in the competitive environment we should have been much more responsive to and cut the position. Gas producers, more of a story about how super low money is really changing, and similar maybe to Chinese internet, just where you've got ample supply of venture capital to create these unicorns. Supply of capital to the shale market in the US, whilst it was being rationed to the dry gas producers, and Range Resources is one of those producers, and CNX Resources, it was not being rationed to the oil market until recently, and the Permian has been much more prolific in terms of barrels produced than we expected. So US oil production has continued to grow, and you get a lot of wet gas or associated gas that comes out. So whilst decline rates have kicked in the dry basins, the overall decline rate for gas has not, and so we haven't had the rebalancing in supply and demand that we expected, and even worse, the cost curve has really flattened. The investment case did not play out, and we should have being more responsive to the changes that we saw. Now, when I talk to European banks and overhyped growth shorts, I would argue these are more issues of timing and potentially relate to some of the style headwinds that we're seeing in the market. Moving to slide 7. So what is the primary, what's driving momentum in the market today? We would argue the debate should be less about value investing versus growth investing, and rather more of a discussion around, why, stocks on high PEs have benefited most from the recent decline in rates. Now, we describe this as duration chasing. You can see here on the chart the Farmer French data for simply the performance of high multiple over low multiple. So when the chart is going up, that's when high multiple stocks are outperforming. The duration bubble, as we describe it, makes the late 2000 tech bubble look like a mere blimp. Even the Nifty 50 bubble doesn't look particularly significant. We are living through unusual times. Now, what do I mean by chasing duration? So if we turn to slide 8, we often hear this discussion, we're all reaching for yield, we're chasing yield. Look, I would argue that if that was the case, investors would be buying a portfolio of highly cyclical opportunities. European banks anywhere in the world give you a high yield. Energy stocks anywhere in the world give you a high yield. So I struggle with this idea that we're chasing yield. What we're showing here on the chart is the blue line is what a European bank, the average European bank, pays you in a dividend yield, and that is at roughly about a 50% payout ratio, so not an aggressive payout. European banks could suffer significant profit compression and still maintain their yield, their dividends. Now, clearly the market must be thinking that's about to happen. Whether it's a tougher economic environment, credit costs could go up. Secondly, the ECB monetary policy is not favourable to banks to the extent that we're just bringing rates lower and puts pressure on net interest margins. But by the way, in oligopoly markets, many of those negatives can be offset by pricing power. So our holdings are in banks where we believe we have pricing power in Europe. So we think this is more an issue of timing. But why haven't they worked? Well, let's look at how European bank credit. So this is the yellow line is how European banks, how they price their debt when they issue debt in funding markets. So European banks, for a debt instrument of about 4.5 years term, can raise money at roughly 35 basis points per annum. Now, you have to ask yourself, if the outlook for European bank equity is so horrible, why aren't those risks being applied to the bank credit? Now, we would argue the reason is that investors are actually chasing duration. Now, what is duration? It's a very simple concept. It's often applied to bonds, but it also applies to equities, and it applies to any asset class. It is simply how long it takes to have your starting price repaid by cash flow. And it's a simple outcome that as discount rates approach very low levels, it is those assets or securities that have the longest duration that benefit the most. So by definition, if you're equity on a very high multiple, your share price is most sensitive to those changes in the discount rate. Now, it doesn't mean that you're appropriately valued. It simply means that you have the most sensitivity. And I think that's what's happening in the market as central banks, as the economic environment has deteriorated, which has hurt many of our cyclicals or low PE stocks, and rates have fallen. People have continued to crowd into the high PE parts of the market. And you can see it on the next slide on page 9. The red regions of the heat map are those sectors that are a lot above their longer term multiple, and the blue part, and you can see the blue part is either global cyclicals or is the more domestically oriented part of the market outside the US. And that hasn't helped our positioning, because we have tended to be in some of the cheaper names, which have, we would argue, the secular growers that are being they're in more cyclical parts of the market, but they're ultimately going to morph towards being secular growth stories. And then in our domestic exposures, we've been less exposed to the US versus Asia and Europe. Now, what can turn that around? Well, on slide 10, I think it is interesting that whilst the trade war, which we should have been probably a little bit more responsive to in cutting some of the more excessive, some of the more cyclicals of the cyclicals, if you like, has firstly impacted Europe much more initially than the US. But as you can see now, Germany is is approaching a recession. Non-German Europe is stable, I think, because it is less exposed to trade. And then you can see US is catching down. So outlook for US is weakening. Now, where is the ability, if we're at this point where central bank policy is not really stimulating aggregate demand, and Jeremy Powell, has even stated that the toolkit in terms of offsetting trade uncertainty is increasingly limited. Yes, they can cut rates, but it's very hard to keep cutting rates in other parts of the world when you're already at the zero bound. So Germany, we think we're going to talk less about monetary policy going forward, and we're going to speak a lot more about fiscal policy. And in some ways, it's back to the 60s and 70s. And Germany and Europe more generally has been in austerity mode, and given what's going on, in the German economy, also given Brexit risks, and the fact that we also have a new president coming into both the ECB and the European Commission, we actually think there'll be much more open consideration of targeted fiscal stimulus. And that will have implications for portfolios. How are we positioned on slide 11? We do believe that central bank failure is real, populism is here to stay, and it ultimately leads to much greater fiscal stimulus. And on that roadmap, keep an eye out for inflation. We're not saying inflation's coming today, but certainly if we become more and more experimental with fiscal policy, that has to be a consideration. The US tailwind on stimulus is fading. Probably expect another one coming if Trump can get an executive order past the Democrats. We may get one prior to the election. Increasingly, the pressure is on Trump to resolve the trade war, given how much the US economy is slowing and how close the election is looming. Probably the issue there is the Chinese sniff weakness, and they may just enjoy a little bit of pain before they give a win to Trump. Our European and EM domestic exposures, when we look at the valuations, are pricing in a pretty tough environment, a recessionary environment, as are the cyclicals. So we would argue, and we hear a lot, well, what if the world does become Japan? And I invested in Japan for a period of time, and I lived that experience. And what was interesting to us was, whilst the cycle did become a little less pronounced, it didn't die. And it certainly didn't favour growth investing over value investing. So we'd argue the cycle will become more dependent on fiscal policy going forward, which will require a different toolkit. And to navigate these difficult or uncertain times, look for quality and growth in less obvious parts of the market. Slide 12 is just some of the evidence that we put forward in terms of how cheap the domestic sectors, i.e. the non-global multinational parts of the market, which shouldn't be analysed on a regional basis, how cheap they are outside the US. And it's not a question of just buying them because they're cheap, but let's look for structural growers in that part of the market. Then when you look at the the overall Antipodes portfolio on slide 13, we're trying to give you just a high-level view of what we own long and what we're short. We're generally long stocks that if you're just thinking about what multiple we're paying versus the opportunity set, we're in the 67th percentile cheap, and we're short stocks that are basically on average 30th percentile expensive. Now, for a lower multiple in our long book, we're also getting higher growth. So don't worry, we're not going into the gutter. We're actually we're looking, at least on a historical basis, we're buying companies that have above average growth, and our shorts have less growth, and our longs have more resilient balance sheets versus our shorts. On slide 14, just finally on the portfolio, our overview of the portfolio. In the global part of the market, we're 43.7% long, and we're short 10.7 to be 33% net. In the sectors or the clusters that are more oriented domestically, in North America or in Europe, we're 21.5% long and 10% short to be 11.5% net. And then finally in Asia, EM, and Asia obviously does include some developed economies like Japan, Taiwan, Korea. We're 26% long and 3.4% short. We've found it harder to find appropriate shorts in what is a cheap, arguably relatively cheap market, to be 22.2% net. And then we have our tail risk hedges on the long side, our gold exposure, and then on the short side, a combination of index shorts, either by futures or puts, and credit protection.
Thanks, Jacob. And so in summary, current positioning, or as at 30 June, 65% net exposure to the market. Just before we go to questions, I'll just reiterate some of the points that we focus on in order to be a best-in-class LIC. First and foremost, obviously, portfolio performance. And as Jacob's explained, the portfolio does have significant protection built in, that low net exposure, tail risk hedging, etc. We aim to outperform over the cycle with less volatility than the market. And we're prepared to give up some upside in order to defend on the downside. In terms of capital management, I stated at the top of the call, the board's very focused on addressing the current discount and hence the on-market share buyback. In terms of shareholder alignment, the team and individuals and the firm of the manager have been acquiring shares in APL, which we view as attractive. And on the left-hand side of that slide 15, you can see as far as transparency, communication and market support is concerned, together with our colleagues at Pinnacle, we're really ramping up those efforts more and more. Slide 16 highlights a few of those initiatives, being webinars, summits that we've participated in recently, and a new revamped website for APL, the company, that will be launched in the coming days. With that, I'd like to open up for questions from shareholders. So if you have a question, please press the button and follow the instructions as indicated.
Hi, Jacob. Just a quick one on trade wars. How will the end to the trade war impact the APL portfolio on an absolute and relative basis to the benchmark?
Thanks, Sam. Look, an end to the trade war, I suppose, the first part of that is what is the likelihood of that, and I think you could break that down into de-escalation around tariffs. I think that should, in a rational way, should happen. So our cyclicals, some of the cyclical stocks, the cost of performance would be, I think, some of that would certainly reverse, and the ones that have longer term opportunity to grow, certainly in thematics like EV transition, the auto sector has been hit very hard by trade war. So long-term growing auto-exposed names will make you quite a lot of money, I think, in that environment. And that's why we continue to hold them. Now, if you think about tech supply chains, the trade war is actually more, not so much, yes, it gets expressed through tariffs, and there's this idea that, Trump wants to bring jobs home, but quite frankly, that doesn't happen anyway. Those jobs just get shifted out of China to Vietnam. It's more, I think, a war about, geopolitical supremacy, and it's about technology and access to critical technology. And China, regardless of whether the trade war de-escalates, China has lost, there's a complete loss of trust between these two superpowers. So China will increasingly diversify its critical tech component supply chain away from the US, from US companies towards Korean, Japanese, and Taiwanese companies, many of which we own, best of breed component suppliers, and that is already benefiting our portfolio. And, so broadly positive for markets, but there will be, definitely, and probably more of a rotation out of, some of the expensive bond proxies, the duration winners, and more into some of the cheaper parts of the market.
Hi, Jacob, thanks for that. GE's in the portfolio. Obviously, it's come under some scrutiny recently. What's your updated view, given it's short at the moment?
Yeah, we own GE, and we've owned it for a while. As a long, yeah. It's a long position, just to make that clear. The short report, we've gone through it with a fine-tooth comb. There's probably about 2/3 of it, or 75% of it, you can actually check against lots of public documentation, and, we think most of those arguments are generally flawed. As always with these short reports, there's a chunk that you cannot really ever know. We've certainly gone to GE and asked some questions around the long-dated care business is it's the part of the business where we've spent a lot of time trying to understand how much provisioning they have. We think it's adequate based on benchmarking against other companies in that space, and certainly, GE have told us that they believe it's adequate. So we've done the due diligence. The question is, how do we position size, to the extent that there's some element of truth, and that's really just looking, we're 1.8% exposed to GE. We think ways we can hedge some of the downside parts of the argument, but your protection is ultimately the quality of their businesses, which is exceptional. You have the world's best aerospace business, one of the world's best healthcare diagnostic businesses. These are unique assets. That's your protection.
Okay, thanks, Lisa. So all that remains is for me to thank shareholders for joining us on the call this morning, and just reiterate that the slides, if you don't have them with you, are available on our website, antipodespartners.com/APL, also via your usual ASX announcements feed, or you can email us directly. We really look forward to seeing shareholders at our AGM in November 6th. We'll be sending out invitations and materials relating to the AGM shortly. So once again, on behalf of the company, thank you shareholders for joining us this morning.